And it's 10 a.m. right here in Lagos, Nigeria. Good morning, good evening, wherever in the world you're watching from. It's Business Morning live on Channels Television. I'm Ladi Williams. First off, let's take a look at what's happening in the markets. We see oil prices rose early today, bouncing back after earlier falling more than $1 a barrel as Russia's invasion of Ukraine continues to dominate volatile trading with ceasefire talks, latest market trigger. Brent futures were up 83 cents at $100.74 a barrel. U.S. West Texas Intermediate crude rose about 58 cents to $97.02 a barrel. Both contracts had earlier declined more than $1, with Brent falling to $98.86 a barrel and WTI easing to $94.90 a barrel. Ukrainian President Volodymyr Zelensky said in a video address released earlier that the position of Ukraine and Russia at peace talks was sounding more realistic, but more time was needed. Prices have come under pressure in recent days over concerns of slowing China demand as the world's most populous country and second largest oil consumer imposes stringent measures to contain the spread of COVID-19. And two international oil companies, Shell plc and Eni, have declared force majeure on key oil flows from Nigeria. Shell's measures, which has been in place since March 3rd due to a decline in flows to the export terminal, applies to its Bonny export program, while Eni's measure, which applies to brass crude cargoes, follows a pipeline blast in Bayelsa State. The developments, which comes amid concerns over global impact of Russia's invasion of Ukraine, could deal a major blow to Nigeria, which plans to export 1.5 million barrels per day of crude this month. All right, we'll take a short break now. When we come back, we'll look at Nigeria's inflation figures and trade data that came out yesterday. That's in a moment. Just stay with us.
One more time. The conference room of the National Bureau of Statistics comes alive as officials converge to intimate Nigerians on the latest consumer price index for February. While headline inflation is pegged at 15.7% in February, food inflation came to 17.1%, with Kogi, Enugu and Kwara states leading the pack, while Sokoto state is the least at 13%.
Before the government can adjust the salaries and wages of its workers, the National Bureau of Statistics is usually contacted to provide the necessary guidance as far as the adjustment is concerned. And so in doing that, it is the consumer price index that we usually use to carry out some permutations from the base year to the current year for us to be able to arrive at the realistic figure of the current year.
And then comes in the presentation of trade statistics. Top 5 export trading countries include India, Spain, France, Netherlands and Indonesia, while the bulk of imports came from China, Belgium, India, the Netherlands and the United States of America.
International trade statistics are important indicators that enable countries to compare and prepare multilateral and as well as bilateral negotiations within the framework of common commercial policy and evaluate progress in regional markets.
Both the inflation figures as well as the trade statistics are to provide a sense of direction for policymakers towards implementing policies that would help improve the nation's economy.
All right, let's make sense of these numbers now with Damilola Shimizu, macro strategist, AfroInvest Securities Limited. Great to have you on the program. Good morning.
Yeah, good morning, Ladi. Thanks for having me.
Yeah, so starting with this inflation data, were you surprised with the, increase in headline inflation, because you projected a further moderation to about 15.2% at the beginning of February?
Yeah, thank you. So the surge in February inflation number just highlights to us how quickly a major economic setback, or what I would describe as economic shock, can quickly turn around the dynamics of economic indices in a country. What I mean by that is So at the time we're making projection for February inflation, in our model, there was nothing like Nigeria importing a dirty fuel then. And we made the projection towards the tail end of January. But we all recall that February was a devastating month for a lot of businesses because of the dirty fuel that was imported into the country. As a matter of fact, the queues have not fully been taken completely out of filling stations. So businesses struggled in February. And also, our model does also not take into consideration the crisis that began between Russia and Ukraine, which sent crude oil prices to over a decade high of above $100. So all these dynamics fed into price level in February, which were a major shock, which no one saw coming as of January. Diesel price, for example, rose from barely 490 in January to almost 700. In some places, 700 in February. So the effect of all this material surge in energy prices impact on production capacity as well as cost of production, and producers had no choice than to pass through some of these costs on consumer. And it's quite interesting that for the CPI basket, every item that makes up the CPI basket had an increase in terms of their index in February, just to tell you the whole round pressure that hits the economy. And they just concluded one. So basically, we did see the surge coming, but we just have to live with the reality because there was a major economic shock in February.
Right. Quite interesting. This time around, the increase in headline inflation was mainly driven by the core inflation component and not the food component. What do you make of this?
Yeah, so let me start by this. The year-on-year food inflation numbers, which show a moderation of about 2 basis points to 17.1, is actually clouding a lot of reality. Because if you look at the food inflation itself month on month, food inflation rose 25 basis points month on month, even higher than core inflation that rose 8 basis points month on month. So why food inflation moderated in February was just because we had a high base year impact for the food inflation. As of this time of last year, food inflation was in excess of 17%. So it was easy for a weaker pressure on food prices to still deliver a moderation this time around. But when you talk of core inflation was about barely above 11% as of February last year. So the pressure that we felt on all the items on the CPI easily manifests on the core inflation component, which reflects the average change in price of a general price level of items that are not non-food items. So, but the truth of the matter is that if you look at the month-on-month reading, core inflation rose about 8 basis points, inflation rose by 25 basis points. It shows you that there was a material pressure on all items in February. And like I mentioned earlier, for all the basket of items that makes up the CPI reading, food inflation even have the highest increase, moving from 7.7 in January to 9.1. So the moderation in food inflation in February is, in terms of year-on-year reading, is actually not reflecting the reality of what played around. And that is why the month-on-month reading is giving us a clearer sense of what actually happened, because we had a material surge in food prices as well.
Quite interesting. But looking at PMS now, a lot of analysts have argued for the removal of the PMS subsidies. You know, with this renewed inflationary pressure, do you think the federal government made the right call, you know, on the subsidy removal?
I really don't think there's any gain for Nigeria retaining subsidy payment. And I'll paint a simple scenario. So last year, FG's revenue as of November for the budget was 5.5 trillion. And that amount was part of what the government needs to fund the 14.6 trillion budget for 2021. So that means that and last year we paid about 1.5 trillion subsidizing PMS alone. So if that 1.5 had added to the 5.5 the government had realized as of November, it means government revenue would have been 7 trillion. And the extent of borrowing wouldn't have been as much as it is. It was surprising and quite interesting when I checked yesterday and saw that between January last year and now, CBN has increased its wealth and means provision to the federal government by another 4 trillion. That tells you that the government is spending more. And this is not far-fetched. if revenue is 5.5 trillion as of November, and we are done 4.2 trillion servicing debt, so what is left for the government to meet recurrent expenditure as well as capital expenditure is less than 1 trillion. So it means the more we keep funding a subsidy that is not beneficial to the generality of Nigeria, the more the government will continue to struggle. And I can also argue that economic indices in Nigeria is actually not better than that of the countries where subsidies are not being paid. Using Ghana as an example, Ghana economy is expected to grow about 6% last year. I did just 3.4. Ghana GDP, Ghana inflation is about 30% less than Nigeria. Unemployment in Ghana is in the single digits of about 4%. Nigerian unemployment is at a whopping 33%. So when you talk of exchange rate as well, Ghana exchange rate to a dollar is below 8 cedis to a dollar. Here in Nigeria, the official window, you need to have a 416 naira to get a dollar. So who is the subsidy really benefiting? It's only benefiting the large, the few people who fall in the high income category, who can afford to run a lot of luxury cars, as well as run generator for 24 hours. So the truth is that the money that being incurred in subsidy would have been used to improve energy supply. In the last couple of days, we've had the national grid collapse like 2 times. These are the things that are mounting pressure on businesses, and that is making Nigerian business environment to be unattractive. So if government remove subsidy and channel this money to develop a key infrastructure like electricity, like the road, companies don't need to run 24/7 on diesel, on fuel. And if they have power and companies are not running on diesel and on fuel, then the cost of operation for businesses will be reduced. And even if PMS is selling at 400 or whatever price that is supposed to be selling, it will only just be for transportation and not for production, not for running companies, businesses that is actually dropping a lot from Nigerian manufacturers. So my point is the subsidy regime is actually doing us more harm than good. Yesterday, it was also reported that the Nigerian government is planning to tap into 2.2 billion out of the 4 billion raised in Eurobond last year to fund the subsidy regime for this year. And with oil price above $100 this year, our subsidy cost might actually be heading towards 3 trillion, which invariably will be claiming almost, half of what the government can likely generate in revenue. So we're losing so much by continuing to subsidize PMS than actually taking it off.
Right, I guess the PMS subsidy saga carries on now. But, moving to the foreign trade data, Nigeria's total trade with the rest of the world, jumped about 57.5% year on year in 2021 from 39.75 trillion naira to about 25.22 trillion naira in 2022. What do you think drove this material jump in trade numbers?
Yeah, so what drove trade numbers last year is the fact that we are coming from a low base. We all recall that 2020 was a pandemic year. The global supply chain was nearly completely crippled by the pandemic and the disruption. But following the development of vaccine and the administration of vaccine, the global supply chain began to pick up. Prices of commodity began to pick up. In 2020, oil price was below $50 for most of the year. Last year, oil price averaged about $70. So all these dynamics played into the trade number last year. And it will quite interest you that while we want to highlight the fact that Nigeria total trade jumped over 50% last year, it will quite interest you that our deficit too is hitting a new high. As a matter of fact, we are recording the highest trade deficit on record since MBS began to provide data on foreign trade statistics in 2010 at 1.9 trillion. So, which was actually driven by the material jump in our import as well, because while exports rose about 59% last year, imports rose faster at 64%. But basically, what drove the numbers, what drove the increase that we witnessed was just the reopening of the economy, as well as the fact that we are coming from a very low base. But in terms of the balance of things, our deficit number is not pointing to something very positive.
And, it's quite disturbing to see that the size of the trade deficit, is the highest year on year. But the MBS began to publish, since it began to publish, but what impact do you think this trend will have on, Nigeria's foreign reserves and current account balance, if this is sustained in 2022?
So let me start with the current account balance. The trade component of the current account balance actually accounts for the largest share. Most time, almost 50% of the component of the current account, because we have 4 components of the current account. We have trade account, we have services account, we have transfers account, and income account. Historically, we have always been recording negative on services account. For the years that Nigeria have recorded positive current account balance, that always come from goods trade, because that is the largest part, and that is when Nigeria had the strongest point. So the last time we had a current account surplus was in 2018, and our goods trade was in the positive territory. So if in 2021 our goods trade statistic is showing a deficit of 1.9 trillion, I wouldn't really be surprised if at the end of the year, when the CBN will release the current account numbers for 2021, yeah, we are still in deficit region, because I doubt if the support from improved remittance, which is on transfers account, will be able to offset this huge gap. And it continues to underscore the fact that Nigeria consumes more than its economy can produce, and it's actually not good for us. So it is also underscore all the fundamental challenges that needs to be addressed by the government, so that our need for FX will be reduced. And that is where it begins to have pressure on the foreign reserve, because when your need for dollar or your import is way above, higher than your export value, so the best that will happen is that you put pressure on your current account, or you borrow more to strike the imbalance, to clear up the imbalance.
All right, but do you think the ongoing, Russia-Ukraine tension poses, any major threat to the outlook of Nigeria's merchandise trade in 2022?
Well, maybe not so significant, but yes, to an extent, because Ukraine, for instance, happens to be among Nigeria's top 10 import destination. I think as of Q4 2021, Ukraine ranked 7th in terms of Nigeria's top 10 import destination. So with this crisis, the few things that Nigeria is importing from Ukraine will suffer a significant setback. Also, Nigeria do trade with Russia too. So the major thing we import from Russia has to do with fish, so herring fish. But the truth is that with this conflict as well, and the increasing sanction on Russia, it will have it will have slight impact on the economy. And I've heard a lot of producers who need wheat, who uses wheat and some other cereals imported, already highlighting potential loss they may likely face, or cost pressure they may likely bear this year due to the ongoing tension. While the effect may not be as huge if this tension were to be between China and any other country, I think the Ukraine-Russia tension will also have slight impact on Nigeria's trade position, especially weighing on our importation spending, because it means we have to trade with other countries whereby our exchange rate may not be as favorable as what it would be if we're trading with Ukraine and Russia. Right.
Anyway, MPC meets next week. We'll see how the decision goes, because every central bank now is trying to battle inflation. Inflation is the enemy right now. Thank you so much, Damilola Shimizu, macro strategist, AfriInvest Securities Limited. Always great having you on the show.
Thanks for having me.
All right. So after the break, AFEX Commodities market update is next. Do stay with us. This is Business Morning. All right, let's take a look at what's happening at the AFEX Commodity Exchange for the week ended 14th of March 2022. The AFEX Commodity Market summary was quite mixed, with a number of deals up 44%. Meanwhile, volume traded was in the red. Join us now. We have Michael Martin, Portfolio Manager at AFEX, with the details. Great to have you, Michael.
Hi, Ladi. Good morning.
Good morning.
It's a pleasure to be here.
Yeah, so give us a rundown of activities on the exchange.
Thank you very much, Ladi. So if you look at the table in front of you, we saw a bit of a decline in the number of activities on the exchange, in the week under consideration, with the total, turnover in terms of the value of transactions traded on the exchange falling by about 60%, from 3.66 billion to close to trading week at 1.45 billion. The total number of contracts traded on the exchange also fell by 61%, from 13.82 million contracts to close to trading week at 5.32 million contracts. contracts. The number of deals, however, went up by 44%, from 340 deals to close the trading week at 490 deals. The ACI, which is the AFEX Commodities Index, went up slightly by 1.25%, from 468.39 points to close the trading week at 474.27 points. The AFEX Export Index, however, fell slightly by 0.58%, from 198.65 points to close the trading week at 197.50 points. With regards to the volume of contracts traded on the exchange, like I said earlier, we generally saw a decline of about 61%, with the greatest changes happening with maize, which fell from 8.94 million contracts traded last week to trading just 4.4 million contracts trading this week. Paddy rice also fell from 4 million contracts last week to just trading over 1,000 contracts this week. Sesame traded downward from 491,000 contracts last week to trading no contract this week. With regards to the number of price changes in the exchange, we saw the biggest change happen with cocoa, which fell by 7.76% to close the trading week at 1,294 kobo per kilogram. Maize also fell by 1.94% to close the trading week at 325 naira 20 kobo per kilogram. Paddy rice also fell by 1.84% to close the trading week at 230 naira per kilogram. Sorghum also fell by 0.96% to close the trading week at just over 226 naira per kilogram. And last but certainly not least, we had soybean, which fell ever so slightly by 0.08% to close the trading week at just over 400 naira per contract. So those are largely some of the price changes that we saw, on the exchange in the week under consideration. And as we always mention, if you want to know more about the commodities market, you can always go to our website, which is www.afexnigeria.com. And if you want to get started trading commodities, you can always download our app, which is available on iOS and also on Android.
All right, thanks for that, Michael. But let's talk about, protectionism now. In recent years, there's been a debate, over free trade and protectionism, government policies that, restrict international trade to, help domestic industries. That has actually intensified. We see industrial countries actually losing market share to, emerging economies at an alarming rate. So kindly tell me the implications, of trade policies. It's important in terms of, market deepening and expansion.
Thank you very much, Ladi, for that question. And I think even before we address that, I think it's important for us to look at the economic equation, right? So if you look at the economic equation, which essentially stipulates that the GDP of any country is equal to the consumption, the investment, government spending, and then the country's trade position, I think it's broadly important to note off the bat, that the country's trade position, has a very, large implication on the country's economy. I think it's also important to know that in any given situation, the ideal is actually a trade surplus position, whereby you have more, exports, than imports. If you look at Nigeria as a case study, we've been in a trade deficit over the past 5 or 6 years, give or take. We were in a great trade deficit to the tune of about 33 billion in the year 2020, and about 25 billion, in the year 2019. The figures for 2021 are not out yet, but I'm guessing, my best bet is they're probably continuing the same trend. And if you look at some of the industries that contribute the largest, to our export position, the largest of which is, of course, the petroleum industry. And if you look at the trend over the past decade, we have, slowly reducing in production, numbers. And it's also the case that the price, of petrol, of Brent crude oil has also been inconsistent over time. So we saw that massive price decline in 2016 due to the supply shock. We also saw that massive price decline due to COVID-19, and then also, the issues that we had in April of 2020. And so that has largely contributed to why we are now currently having a negative trade position. If you look at another subsequent industry like the agricultural sector, it is the case that, yes, maybe our production, numbers are growing on a year-on-year basis if you look over the past decade. But it is the case that agriculture only constitutes, a small percentage of our, current trade position, such that any small change, in our agricultural position wouldn't necessarily bring about a larger change in our country's trade position. Let's not even talk about our manufacturing sector, which is for the most part non-existent as of today. In terms of the trade policies that any country can sort of put into place, there are broadly two that essentially come into play. So the first one you have is a protectionist measure, which is basically, the government of a country limiting the amount of imports that you have into the country, which is essentially supposed to help encourage, the growth and development of local industries, in the production of goods and services. And then the other one is more of a free market system whereby you allow the free flow, of goods and services in and out of a country. I think both of them are good, and I think both of them have different implications on, on any given economy at any given period of time. So the first of those implications, of course, would be, employment. Secondly, would also be for market access, and then thirdly, and I think most importantly, would also be on the strength of a country's, currency. So if you're in a trade, surplus position, it is the case that the currency of that country, is going to be stronger essentially. What you tend to see, or what is usually advised, is that if you're an emerging market, what is expected of you is for you to have some sort of protectionist policy that essentially allows you to grow your own local industry so that you can then, produce, goods and services before you then move into a free market system that then, allows for the free flow of goods and services between different nations.
Talking about, free flow now, Nigeria has a couple of trade barriers, lack of transport infrastructure, inefficiency, and opacity in the border administration. What are the policies, that could help overcome, some of these barriers?
To be honest, Ladi, I think, yes, the trade policies are important, right? But I think it's also important for us to take a step back, right? When you think about trade policy, if you have trade policies without having the necessary infrastructure, that are important for you to underscore those trade policies, they don't necessarily work. And what I mean by that is this: if you're just trying to address, the trade policy issues without addressing the underlying infrastructural issues, you're essentially building a house of sand. It is going to collapse, sooner rather than later. So take, for example, with regards to just the exportation of commodities, in and out of the country, some of the issues that we very often encounter, it's not uncommon for you to find that, goods will be delayed at the ports for, 2 or 3 months, depending on what the port situation is per time. And what this does is that it has significant implication on the country's trade receivable position, right? And our ability to also move goods from one place to another. Issues that that currently exist within our transport system have also not been resolved, right, to a large extent, right? So without trying to layer on trade policies without actually solving some of those structural issues, will not essentially work. You can't just build, quote unquote, a house on just trade policies without addressing some of those key structural issues like like transportation, and then also storage, and then some other key infrastructure necessary for trade too.
All right, but what are trade policies that could actually assist achieving macroeconomic stabilization, particularly, in light of this, the present disruptions, we're seeing right now?
So in terms of the trade policies that we can put into place, I think one thing, is important, vastly more important. I think the first of which is, we need massive investments, in infrastructure. So take, for example, I had mentioned earlier how, petroleum is a significant contributor to our export position, as a country. And we currently have somebody like the like of Dangote making massive investment in that infrastructure. When that refinery, is essentially completed, that would, massively reduce the amount of money that we spend on a year-on-year basis, to import petroleum into the country. I think those type of investments, right, across board, not just in the petroleum industry, but also in the manufacturing industry, and then also in the agricultural industry, are some of the trade policies that we can put into place. Are some of the trade policies that we can sort of put into place to encourage those type of investments, right? Because it goes without saying that we do need, massive investment in infrastructure in this country, for us to be in a better trade position. In terms of macroeconomic stabilization, you can look at some of the macroeconomic indicators, right? So take, for example, you want to promote more, foreign portfolio investments into the country, and the major way by which you can do that is also to increase the interest rate so that local assets are essentially more more inviting to international investors, so that you can then have the importation of international currency. I think another issue that could also be addressed with regards to that is when you look at the way the pension funds are currently structured, it is the case that most of their portfolio allocation is to the fixed income and also to the government. So it is the case that most of their most of the amount of money that they allocate on a year-on-year basis is to the federal government. What we need is a lot of that fund also being redirected, also to make massive investment, not just in financial assets right now, but also in, infrastructure. And the way we are going to do that is by, actually actively designing products that can help their risks, those type of investments for, those type of investments essentially. I think the third macroeconomic indicator that we also need to look at, which is also more important in light of recent disruptions that we've had in the economy, is also the inflation rate, right? So what that does is that, ideally you're supposed to have, an influx of both international capital and then also local capital, for you to grow your infrastructure base. What is currently happening right now is because of the high inflation rate in the country, capital formation is essentially extremely difficult, for the average Nigerian individual, and that has a significant impact on savings, and that has a significant impact on wealth and how much money we are able to lend into the economy. If we can address some of those, address some of those trade policy issues and then also monetary policy issues, I think we can start seeing both massive investments in infrastructure and then also massive, investments in financial assets that currently exist, within the country.
Quite a lot of investment needed there. But what is AFEX doing, to help in that space?
Ladi, I think I've mentioned this, like 100 times already, but we've built out over the past 5 or 6 years, right? We have built out massive, infrastructure with regards to, the storage infrastructure that we have in the country. So as of today, we have more than 110 warehouses, across more than 23 states, which is a massive infrastructure needed if you actually want to produce commodities, store them, and then also export them, outside the country, or whichever the case may be. We've also provided, the trading infrastructure which allows, market access for both local investors and maybe more importantly in this case international investors, right? One of the things that we also try and do in that regard is also to provide enough data, right? Because part of the reason why they're not currently investing in that space is because they don't have enough data for them to compute some sort of risk profile for the country so that it can essentially weigh the risk return, right? So what some of the things we're also doing at our own end is to provide farm data, production data, consumption data, and then also investor data too, so that they essentially have like an holistic view of what the investment landscape is, and then they can address their capital, as necessary. And that is alongside, and I think another important thing that we're also doing, which I've also touched on before, is that we're also structuring, quasi-complex financial products, which should essentially help, how do I call it now? Which should essentially help investors, right, invest in our own capital assets, right? So the ability to design those financial products, which would essentially allow, give market access to international investors, I think is also important, not just for the commodities market now, but also for the stock market and then also, for the fixed income market too.
All right, Michael, always great to talk to you. Thank you so much, Michael, for the update. We'll keep tracking, that market to see how we can make some profit right there. Thank you so much, Michael.
You're welcome, Ladi.
All right, we'll take a moment now. All right, let's take a look at what's happening in the markets. We have Anita Edit there, right there with all the details. Great to have you, Anita.
Yes, good morning, Ladi. Well, I'm starting off the markets. First, yesterday I started with the equities market, but this time I'm starting with the fixed income market. And of course, speaking about the fixed income market, it was a little bit mixed for the bond segment of the market. This comes as average yield stayed flat at 10.4%. Then across the benchmark curve, the average yield was unchanged at the short and the long ends, but it expanded at the mid segment. This follows sell pressure on the February 2028 bond. But when you take a look at the board here, all we had, the highest number of deals was carried out on the 22nd of January 2026 paper right there, and then it had a value of 3.40 billion naira. In total, the number of deals carried out on as at yesterday was 13, and a value of 5.5 billion naira. Switching over to the Treasury bills market, it was it traded in the law. The average yield there closed flat at 3.5%. What we had as at the close of Tuesday's trading there was one deals on both the 25th of July as well as 25th of August 2022 papers. So they had a total of 1 billion transactions there. Flipping over to the OMO markets, of course, this is the CBN special bills. We didn't have any activity there. Here, it was the market there. The average yield was also unchanged at 3.8%. So, total number of deals there was 15. Now, to tell us more about the market, especially as regards yesterday, and then also what to look out for today, let's talk to Caleb Alimi, who is a fixed income dealer at FSDH Merchant Bank. Thank you for joining us, Caleb.
Thank you for having me. Good morning.
Okay, so for a second day this week, we're having the fixed income market, particularly the Treasury bills segment, having some kind of bearish sentiment. So can you tell us more about what's happening there? And then also, we will be expecting the CBN to carry out a primary market auction today. So give us more insight into this.
You may see a slightly bearish tone in the Treasury market, and that is not connected to the fact that investors, expect that the government to continue to borrow more. So they're demanding slightly higher rates at the secondary market, and that's why you've seen maybe in the last 2 days, slightly inched up. There is a primary market auction today for Treasury bills, where the federal government is off 53 of the 1 year paper, about 3.6 billion of the 182 days, and about 960 million for the 91 days. Given the liquidity situation on the market, the interbank market is quite liquid. System liquidity is positive. We expect that this primary auction, there will be strong demand at the primary auction. The last auction closed at 4.1% for the 1 year paper, 3.28 for the 182 days paper, and 1.75 for the 91 day paper. We expect to see a slight drop at this primary auction today, largely because of what I said, being the positive interbank liquidity, system liquidity in the interbank market. We expect that to have a drag down on the rates at this primary auction, largely because investors also see that at this auction, they're able to clear very decent size of their demand at the auction. Today's market is going to be slightly quiet, as most people will take their orders to the primary auction, and then we'll see activity. We'll see, market then react afterwards to the result of the auction.
Okay, so one last question. Yesterday, the MBS released the February report, which shows that inflation was slightly higher. It went up. So, and next week we will be having the central bank's monetary policy committee meeting. So, how do you expect this to impact on the market looking out for next week?
So for next week, or even for this week, we don't expect inflation is not going to largely affect the market for now, until it continues to, trend upwards consistently over the next, say, 3, 4, 5 months before we expect a movement from the MPC. I don't expect the MPC to go ahead of the curve and raise the interest rates before we see inflation peak. Inflation is just beginning to climb, and we expect to see more of that. On our fixed income market, we would not see much of an impact for now until there is a movement in the monetary policy rate, which I expect to probably happen maybe sometime later in the year. Hello?
Okay. Yeah, I can hear you. Yeah.
Okay.
Okay, so I think that'll be all for now, Caleb. So that was Caleb Alimi, who's a fixed income market dealer at FSDH Merchant Bank. So let's move over to the equities market. Another day of profit-taking on the market. Sell pressure from the likes of MTN Nigeria, Zenith Bank, Seplat, GTCO, UBA, NGX Group, and then that's a total of 22 equities that were in the losers list or on the sell list. Constituted to about 47 billion naira loss in market value, which is it translates to about 0.19% drop on the all-share index. Over to the sectoral counter of the market, the sectoral indicators, it shows that it's still a mixed sentiment, but it has mostly the reds there. No thanks to sell pressure on the banking sector counter, the insurance sector counter, as well as the oil and gas sector counter, which means that the likes of Seplat really dented the performance of the market. So in terms of activity, the value was down, volume was down by 85.69%. Value was down by 68.74% in contrast to what we had on Monday. Then in terms of the deals, all in the red, the deals were down by 20.19%. So now for the market, that market is still having some sell pressure, but we don't know. Tomorrow, at the close of today's trading session, maybe the market might tilt to the green, but fingers crossed. We just keep our attention focused on that. Over to the smaller unlisted securities market, it's still sell pressure. This is the second day for the week, and as the market is down, although compared to yesterday we had more than 2.2% decline on the securities market, on that unlisted securities market, and then market cap is still within the 600 billion market cap value.
All right, Anita, we'll watch how investors position for the MPC meeting next week. All right, thanks for the update, Anita.
Pleasure.
All right, we'll take a quick break now. When we head back, we'll get to London, see what's happening there. Do stay with us. This is Business Morning. All right, now let's take a look at what's happening in the UK. We have Juliana right there. Great to have you, Juliana. Good morning. Well, Britain has blocked luxury exports to Russia worth hundreds of millions. I guess oligarchs will be deprived of their luxury goods at this time.
Absolutely, that's the aim, Laddie. Good morning. On Monday night, British MPs passed the long-awaited economic crime bill, which basically means it's going to be much more easier, less time restrictive to pass sanctions and economic measures such as this. And the Chancellor Rishi Sunak announced that there are two new measures that will be implemented to try and squeeze Putin's regime as much as possible. We're entering, obviously, the third week of this invasion into Ukraine. So one is a coordinated effort by Britain and its G7 allies, and this is to stop the exporting of luxury goods into Russia. Now, this is trying to stop the luxury lifestyle, if you call it that, of the oligarchs. So this is about high-end fashion, high-end art, luxury cars. We know that a swathe, I believe there are about 300 companies that have said they are no longer going to be trading within Russia. So many companies have pulled out over the past couple of weeks. But of course, if you're based in another country, you can export those goods. So over the next couple of days, that will be completely outlawed. And there is this new tariff hike, a 35% hike on goods that are coming into the UK. Most notably is Russian vodka, which everybody in the UK seems to be talking about. Clearly, that's a popular item that's distilled in St. Petersburg. So if that's going to come into the UK, that is going to get a 35% hike on the tariff. Also, there are several other items that will be coming on Belarus, because you know that the Belarusians have been coordinating with Putin on this invasion of Ukraine. Now, this is going to affect about $900 million worth of goods. We know that Britain and Russia do have a really robust trade relationship. Prime Minister Boris Johnson has been clear that there is likely going to be some retaliatory attacks from Russia when it comes to these financial sanctions. What are they going to look like? You know, British businesses are just climbing out of this COVID-induced issue that they're facing in terms of trying to get their businesses up and running as successfully again. Last month alone, trade between Russia and Britain was worth about £195 million. So this is certainly going to have a knock-on effect on British business too.
Right, I guess everyone is getting deprived, you know, with this war. Well, U.S. Fed is set to raise interest rates for the first time since 2018, you know, amid soaring inflation. What are investors and analysts saying at this time?
Well, watching and waiting, but in the square mile, I think investors are a little bit happy. The FTSE was trading up above 1% at opening, and all eyes and ears, as always at this time of the month, are going to be on Jerome Powell, the Fed Reserve Chair, to see what he says after this meeting, where we are expecting interest rates in America to be pushed up for the first time, as you said, in 4 years by about half a percentage point. Just like other comparable economies, the US is trying to tackle a spiraling inflation, currently running at about 7.9%. That is huge. That's the highest level of inflation in about 40 years. Of course, there are knock-on effects from Russia's invasion of Ukraine, and, believe it or not, coronavirus, COVID, is still affecting economies. That supply chain disruption that we saw very on in the pandemic is still causing so much trouble. But we are seeing that the US labour market is doing very well. Prices are going up. One of the ways to curb those prices is to raise inflation, to raise interest rates. And so we are expecting that today. But then also, of course, we are going to be keeping a close eye on those minutes as well, because there were indicators before the end of last year that there could be 3 or 4 hikes of interest rates this year, but we're expecting the first one to happen in just a matter of hours.
All eyes on the Fed today. Thank you so much, Juliana. Enjoy the rest of your day.
Thank you.
All right, let's take a look at other markets now. We see Bitcoin there doing pretty well at this hour. See the market cap by $1.75 trillion. It's up 1.45%. 24-hour volume traded in Bitcoin, and the total crypto space, that's altcoins plus Bitcoin, $89.23 billion. That's up about 22.38%. Bitcoin dominance sitting there at 42.64%. We see Bitcoin this morning now, it's $39,405. It's up by 1.46%. We see Bitcoin price formed a base above the 38,000 level and started a steady increase above the $39,550 resistance level, and that's the hourly, the 100-hourly moving, simple moving average. Opening doors for a move above the 40,000 resistance, with the bulls trying to take control there. And we see Ethereum there sitting at $2,641, up 3.44%. That's $15.17 billion traded in Ethereum. And we see most of these coins all in the green at this point. Top odds by market cap, it's mostly green on that count. We see the crypto market looking really good and bullish this morning. Let's bring in Solomon Amunde now, digital market analyst. Hello, Solomon.
Yeah, good morning, Ladi. Good morning.
Good morning, Solomon. Well, quite an interesting trade we're seeing. Earlier at about 3 a.m., we saw Bitcoin spiked above 41,500, then dumped right back to 39,000, liquidating over $200 million in shorts. That's a lot of manipulation.
Yeah, indeed. That's a whole lot of manipulation, and it's not really the first time we're seeing this happening, but it's usually expected. That's why for most traders it's good to not keep a very tight stop loss in your trade. But we are still expecting Bitcoin to go test 41,500 again, and we're still expecting it to hopefully hit 45,000 this week.
That's why the shorting and longing is not for kids in that market. And we see Mark Zuckerberg says NFTs are coming soon to Instagram. Quite interesting. How do you see this impacting the NFT space?
It's a very positive news for the NFT space, especially since we've seen so many new blockchains focus on NFT, and we've been seeing a steady increase in volume. We've hit almost about $2 billion in terms of NFT traded volume. So in terms of reaching the vast community that has not yet understood what NFTs are, I think an Instagram move to bring NFTs to Instagram is a really, really perfect move, if you ask me. Long term and short term, it's really, really welcome.
But I'm wondering how that's going to work. Is it that you could just upload your JPEG NFT on Instagram and maybe sell it?
Okay, so what they are looking at is, one, you'll be able to mint NFTs, and you'll be able to also buy and sell those NFTs on Instagram, which I 100% believe they have the technical manpower to be able to pull that off.
All right, well, we'll keep watching and see how that plays out. Thank you so much, Solomon Amunde, digital market analyst right there. All right, now let's look at the top 5 gainers there. We see Waves topping that counter at $30.96 per coin. It's up 18.41%. We see GRT there up 17.36%. It's seen double-digit gains this morning. The top 5 gainers, we see Basic Attention token there at 82 cents. It's up 14.02%. And Phantom was in the losers counter yesterday, but now it's up about 9.52%, trading at $1.16, and we see CVX there up 9.29%. And top losers, we see it's single-digit losses with Rune leading that counter at down about 6.68%. And we see Pancake Swap been on decline for a while now. It's trading at $5.45 per coin, down about 3.41%. Well, it's still extreme fear in the market, but it's looking quite green right about now. All right, that's it on the crypto market, and that's a wrap on the program. Thank you so much for watching. Do remember to join us at 1:30 on Business Incorporated for more updates and developments in the world of business. Thank you so much for watching. I'm Ladi Williams. Bye for now.